Hello there, and thank you for joining me today to talk about the Western Asset Short Duration High Income Fund. My name is Zahya SDHI, and I work as an internal sales director in the Independent Advisor channel. And today I want to talk to you about three things. I want to start off by talking a little bit about the client profile for the Short Duration High Income Fund, as well as then secondarily run through some client profiling questions that you can use to engage an advisor in a conversation around this product. And then finally, I'm going to walk you through the four whys. Why Western, why the product, why the asset class, and then finally, why now? So let's start with the client profile. There's really three things here, and to step back for a second, the thing I love about this product is it really straddles the fence between fixed income and equity. What I mean by that is if you look back historically speaking over a 10 or 25-year period, so clearly a full market cycle, high yield has actually returned similar like returns to the equity markets using the S&P 500 as a proxy. But it's done that with less volatility, almost half the volatility. So what's great about this product is regardless of who the advisor is and what the segment of his book looks like, whether that's retirees or maybe a younger client base, this is really a product that's going to be appropriate for a lot of folks and something that you can put in front of pretty much any advisor. So the three client profiles I want to point out, the first one is very obvious, clients that need income, and at that a higher level of income, either because they need to shore up their assets for retirement, maybe to meet current expenses, or they're looking to keep pace with inflation. This product is going to help to deliver a total return, but also a higher level of income for those income clients. The second one are those clients looking for an equity surrogate. Maybe they're not completely ready to go back into the equity markets and step in with 2 feet. This is really a product that's going to allow them to sort of take a step out of fixed income, but not go fully into the equity markets and experience the volatility you will there. So again, something that's going to act as a transition into the markets. That's also not only good for the client, but that's also going to be a value add for your advisors who are really struggling to get those clients to move out in the risk spectrum. And then finally, this is for clients that are concerned about rising interest rates. I think given the low environment we've been in, benchmarks at 0% since 2008, this is a product that's going to work well in a rising rate environment. And we'll discuss a little bit more about that in a moment. Now that we've talked through client profile, let's talk a little bit about the profiling questions that you can use. Now I recognize there's dozens of different questions you can use, but just to mention a few, I think the first one is pretty simple. Ask the advisor, what's your view of interest rates today? Where do you think interest rates will be in the short to medium term? And really get an idea of what their view is. There's really two ways this is going to go. Either they're going to tell you they think rates are going to be low for long, in which case you can really pivot to the product and point out the high level of income you'll get in a low growth environment, or they think rates are going up, in which case again high yield is an asset class that typically does perform well in a rising rate environment. Another question that you can use, how are your clients approaching the markets after 2008? How much have they actually participated in the market rally that we've experienced? And then finally, another question you can ask them is, where are you finding income today? Quite simply, where are you finding that income? So that's the client profile, as well as some profiling questions you can use to engage an advisor and really walk them down the road towards talking about the short duration high income fund. But let's talk about the four tenets that really exist as you start to present this product to clients. So let's start with why the asset class, why high income, and more specifically, why short duration high income. You'll see in some of the marketing materials that you use what they call negative is a positive. And what they mean by that is that high yield has a negative correlation to treasuries looking over historic periods. So this really works well, again, if you believe that rates are going to rise, that this is an asset class you want to be in. And if you think about it, it makes sense for two reasons. Number one, high yield is kicking up a higher level of income. That higher level of income should act as a cushion as rates rise for any NAV erosion that you might experience. And then additionally, if you think about the companies you're investing in here, these are small businesses, up-and-comers, or maybe they're distressed businesses. With rising rates, that should be indicative of an improving economic backdrop, which should bode well for these types of companies. So firstly, short duration high income is a good asset class to be in because of its negative correlation to treasuries. Secondly, I've already talked about it, but the high level of income that these are kicking off, that's another benefit for being in the asset class. And then finally, again, I think probably the most important is that it's an equity alternative. Most of the advisors I talk to today are really struggling with what do I do with that fixed income bucket of my client's portfolio. For anybody that's 40 and over, they probably want to have some sort of balance to that equity portion of their book. So again, this is really a nice placeholder for that fixed income portion of a client's allocation, using a product that is fixed income, but again, that should perform well going into the rising rate environment that we're looking at. So that's why short duration, high income, but why our product specifically with Western? To start, I think what's really interesting is this is a bifurcation story. And what do I mean by that? Our product is focused short duration. By prospectus means 3 years or less duration. And how we're going about that is in two ways. Number one, we're looking to buy short dated paper. I'm talking the 0 to 2 year paper on the curve. And we're hoping with that those companies are going to refinance at the low rates that we have today, and that we should enjoy the premium that they'll pay up front to call those bonds away. Aside from buying up the short end of the curve, we then also want to avoid the back end. That's that 7 to 9 year paper that is locked in their rates. They have a pretty good interest rate because they're longer in duration. And when they come to that 5-year call feature that a lot of these bonds have on them, they're probably not going to get called away. So what you have essentially there is embedded duration and embedded rising rate risk. So that's how we really that's really how we go about investing in this portfolio. So the bifurcation story is one. The second point on why the fund is really our flexibility. In this fund, this is not a floating rate or a bank loan fund alone. We have the ability to expose you to that part of the that subsector, but additionally we can also go to other things like vanilla high yield, to emerging market corporates, and then also to middle market debt. And just a quick side note on middle market debt, if you're not familiar with that subsector, I would definitely take a little time and get familiar. It's an area that a lot of advisors are not familiar with, so you can be an educator in that space, and it also highlights the size of Western as a firm itself. So again, flexibility, the bifurcation story, our ability to do the credit research and select specific credits across the credit curve, and then finally our performance. And again, I'm not going to get into numbers because those change, but if you look across the history of this fund, we've done a really outstanding job on delivering total return as well as good levels of income. So that's why short duration, high income, specifically with Western, but let's talk a little bit about the investment manager themselves. I think this is the easiest part of the story, actually. It's very concise. Why Western? Because of the size of the firm, the size of the team, and our experience in fixed income. Western Asset manages $450 billion in total across all of fixed income, and specifically $40 billion of that within just high yield itself. The team itself is made up of 60 credit investment professionals, 30 research analysts, and 12 of those guys are focused specifically on high yield alone. And then finally, the experience of the team. We've been in fixed income investing for 40 plus years. And that really, again, has allowed us to live through a lot of different market cycles. We've lived through past rising rate environments, past crises, and so we've seen a lot and have the ability to navigate all of those different types of environments. So finally, now that we know why the fund and why Western, why now? I think it's three things. Number one, we're living in a low growth environment here, and so again, using a product like this is going to help your clients to shore up assets for retirement, meet their current expense needs, and also pace with inflation. Using a product that's going to deliver higher level of return and higher income. Secondly, the fundamentals in this space are better than they've ever been. Again, we are dealing with high yield, so these are firms that are somewhat on the fringe, but the fundamentals have really improved since 2008. I don't want to do a lot of stats, but here I want to point out that the average default rate in high yield historically had been 8 to 9%. Today it's running at closer to 2 to 3%. So clearly 2008 in that crisis had really weeded out the companies that were not fundamentally sound, and today high yield is really representing a pretty fundamentally strong asset class. And then finally, aside from the low growth environment and the fundamentals being very strong in this space, I think that this is a way to get ahead of the Fed. Again, everyone's really concerned about rising interest rates. This is a fund and an asset class that should perform well in a rising rate environment, given its negative correlation to the Treasury market and given its higher level of income that it kicks out. So with that, I want to thank you again for your time, and definitely feel free to reach out to me if you have any questions.